Recoupments. What exactly is a recoupment? If we have an asset that cost 100,000, from which we've been able to deduct allowances of 80,000 in the past, and we now sell that asset for 90,000, what are we in essence doing? Well, this 90,000 that we are receiving is in essence a recovery of the cost of that 100,000. But we were able to get a deduction for 80,000 of the cost. So in essence, SARS is saying they want you to pay back the deduction that you got because you are now being compensated in excess of those allowances claimed. Therefore, we need to recoup the 80,000 into taxable income. If we had only sold it for 50,000, then we would have recouped 50,000. Section 84A deals with the general recoupment provision. The recoupment of amounts that were previously deducted in terms of sections 11 to 20, as well as 24I and 24J. How do we calculate what the taxable recoupment is? Well, we need to take the lesser of the cost or the proceeds in the sale of this asset, less the tax value. Remember, the tax value will be the difference between the cost and any allowances that we've already claimed. Recoupment in respect of assets is limited to previous allowances, so we don't have to pay back in essence more than what we got as a deduction. That makes sense. So the selling amount, where it is greater than the cost, we also need to go and work out what the capital gain is in that case. Remember, wherever we are disposing of an asset, we need to go and have a look at the recoupment, and because it's an asset, we need to calculate the capital gains. We will take this recoupment and we will fully include it in income unless there is a special provision that allows us to roll it over or gives us some kind of recoupment relief. We also need to consider section 24M, which is our unquantified amounts, and that's relating to level 2, and we'll have a look at that a bit later. Where we have a disposal or a donation of an asset, we have a disposal of an asset, we need to consider whether or not there is a recoupment on that asset. Where it is an allowance asset, we could potentially have a recoupment. A non-allowance asset cannot have a recoupment. We can't pay back something we never claimed. Where the selling price or the market value in the case of a donated asset is less than the tax value, we have a scrapping allowance, and we could potentially get a deduction in terms of section 11O provided we meet the criteria. However, you must remember that section 11O is an elected section, so the taxpayer would need to elect section 11O if they qualify. What are the criteria? Well, if the expected useful life of the asset is less or equal to 10 years and the asset was not sold to a connected person, then we can claim a section 11O deduction. All previously allowed deductions are recouped in terms of either section 84A or 84E. 84A would include the recoupment into our taxable income in full. Section 84E, however, has a deferring provision to it. If section 13.3 is elected, with regards to qualifying manufacturing buildings, we will set off the recoupment against the cost of the replacement manufacturing building. Section 84E defers the recoupment if there is a replacement asset and the taxpayer again has elected either paragraph 65 or 66, depending on how the asset was disposed, in terms of the 8th schedule. Then we can apply section 84E, which is the rollover provision. If we have a look at an example where we have an asset with the cost of 100,000, we got the wear and tear allowances of 80,000, leaving us with a tax value of 20,000. Depending on the selling prices, which we'll have a look at in the next slide, we will need to go and calculate whether or not we have a recoupment, a scrapping allowance, as well as whether there is a capital gain or loss. In order for there to be a recoupment, it must obviously be a depreciable asset, an allowance asset. If there is a recoupment, we're either going to apply Section 8.4a or 8.4e. If there's a scrapping allowance, we need to elect Section 11.0. A recoupment occurs where the selling price is greater than the cost price. If the answer is yes, then we'll have a recoupment being the difference between the cost price and the tax value. In the case where the selling price is not in excess of the cost price, we could still have a recoupment where we look at the selling price less the tax value. The reason we limit the selling price to the cost price is because we need to limit the recoupment to the amount that we had allowances for previously. If we look at the selling prices and we have a look, if we sold this asset for 130,000, so in excess of its cost price of 100,000, we need to, when we are working out the recoupment, limit the selling price to the cost price of 100,000. From that, we will deduct our tax value, which is the difference between the 100,000 cost and the 80,000 deductions that we got. That will give us a recoupment of 80,000 in terms of Section 8.4a. We will also need to work out a capital gain. The proceeds will be the selling price of 130 less the recoupment, so less amounts that are already included in gross income. So 130 less the 80,000 is going to give us 50,000. From that, we are going to deduct the base costs, which is going to be the difference between the cost price of 100,000 less the allowances that we have already claimed. 20,000 will then be our base cost, so the 100,000 less the 80,000 that we already claimed. Therefore, we will have a capital gain of 30,000. Moving on to where we sell this asset now for 70,000. We will have a look at the lower of cost or selling price. In this case, the selling price of 70,000 is less than the cost. We will again deduct that tax value, being the 100,000 that we paid, less the 80,000 we have already claimed deductions for, and therefore we will end up with a recoupment in terms of Section 8.4a of 50,000, which we will include in our taxable income. We should always, when we are disposing of an asset, calculate the capital gain. In this case, it's obvious that there won't be one, but you should still calculate it in a test or exam. So we would again say the selling price, which is 70,000. From that, we are going to deduct the amounts that are already included in gross income, 50,000. So that is going to give us 20,000 proceeds. The base cost will stay the same, being the cost price less allowances that we claimed, so the 100,000 less the 80, giving us a negative 20,000. Therefore, there will be no capital gain. Moving on to where we sell the asset now for only 5,000. Again, we're going to use the lesser of cost or selling price, which in this case was the selling price of 5,000. We will deduct the 20,000 tax value. This results in a loss, in essence, in terms of a scrapping allowance, Section 11.0, the loss or alienation of property. We will be able to elect Section 11.0 provided that the useful life of these assets is 10 years or less and we did not dispose of it to a connected person. Then we will be able to get that Section 11.0 deduction. Again, we have disposed of a capital asset, so we should calculate the capital gain. Although we obviously know there will be no capital gain or loss, we will need to calculate it. Same principle applies. We take the selling price, less amounts already included in gross income. Well, the selling price will be the 5,000, less amounts that are already included in gross income, while nothing was included in gross income. Therefore, we'll have 5,000 being our proceeds. The base cost will be the cost price being the 100,000 less allowances that we have claimed. Well, that's less the 80,000, but now we also are claiming an 11,000 scrapping allowance, so we will minus that 15,000. That will give us a base cost of 5,000, resulting in a 0 capital gain or loss. Let's work through a few more examples. Read through this example and then restart the video lecture. What must we do? We need to calculate the tax implications on the sale of this manufacturing machine, which is sold to a 100% subsidiary, which is a connected person. We sold it for 1.5 million when the market value was 1.8 million, and we originally paid 3 million for it. We are selling it now in year 2, and we purchased it in year 1. If we calculate the tax implications in year 2, assuming a December year end, what is the selling price that we should apply in this case? Well, because we sold it to a connected person, it is deemed to have been sold at market value. Therefore, the 1.8 million, which is the market value on the date of disposal, 1 October, year 2. The recoupment in respect of the sold machinery needs to be calculated using that 1.8 million. Remember, we said we use the lesser of the selling price or the cost. Well, it had a cost of 3 million. The selling price is 1.8. We're going to use 1.8. From that, we are going to deduct the tax value of this asset. The tax value will be the 3 million less the allowances that we've claimed. So we claimed 1.2 million in the first year, 600,000 in the second year, giving us a 1.8 million allowance that we have claimed in terms of section 12C, because this is a manufacturing asset. Therefore, our tax value will be the 3 million less the allowances that we've claimed, being 1.8. So our tax value is 1.2 million. So when we're working out our recoupment, we're going to take the 1.8 million being the proceeds less our tax value of 1.2 million, giving us 600,000, which in terms of section 84A will be included in taxable income. Similar example, the only thing we're going to change is that instead of the market value being 1.8 million, the market value on the date that it was sold is now 3.2 million. Calculate the tax implications for the sale of the machine on fast feathers for the second year, for year 2. Well, again, the selling price will again be the market value at the date of the sale, because we sold this to a connected person. What will the recoupment look like? Well, the value we will now be looking at is 3.2 million. However, we need to limit that to cost, which is only 3 million. From that 3 million, we will deduct the tax value, which remember we calculated as 1.2 million, resulting in a recoupment of 1.8 million. Okay, we are limiting that to the allowances that we've claimed. Well, we've claimed 1.8 million, therefore our recoupment is going to be 1.8 million. That is why we limit the selling price, that value, the 3.2, to cost. For Slow Feathers, which is now the subsidiary company that acquired this manufacturing machine, what are the tax implications? Well, because the machine was bought from a connected person, Slow Feathers, we need to apply the section 12C allowance rules. It is second hand, so they will get 20% for 5 years. But on what value will they be allowed, or on what cost will they be allowed to claim their section 12C allowance? The cost on which we will be allowed to apply that 20% will be the lower of the cost of 1.5 million, or a cash cost in an arm's length transaction. In this case, the arm's length transaction would have been 3.2 million, but what we actually paid as Slow Feathers was 1.5 million. Therefore, we will use the 1.5 million as the cost on which Slow Feathers can claim the allowance. Even though Fast Feathers, the holding company, was in essence taxed on this disposal at 3 million being the market value on the date that the sale was incurred. Now you might remember when we did immovable property, we touched on the recoupment in terms of section 13.3. In section 13, we're allowed an annual allowance on the buildings and improvements subject to the recoupment in terms of section 8.4a, except if the taxpayer has elected section 13.3. If they've elected section 13.3 to apply, that recoupment will not be included in taxable income but will be set off the cost of a replacement building that qualifies for a section 13 allowance. That building, in order to qualify, must have been purchased or erected within 12 months from the date of the recoupment, being the date of disposal. And the replacement building must obviously qualify for an annual allowance under section 13.1. Any excess in terms of the section 13 recoupment over and above the cost of the replacement building will be included in terms of section 8.4a straight into taxable income. If we have a look at an example where we are leasing premises and the lessee has enjoyed a recoupment of past allowances claimed on the cost of a destroyed building, a factory building, to the amount of 500,000. So we've got a section 13 recoupment there, or we've got a recoupment on a section 13 asset of 500,000. The taxpayer erects a further qualifying building, and this recoupment is available for set-off against the cost of the further building instead of being taxed immediately. The cost of the newly erected building is 1.6 million. Now here we're integrating leasehold improvements as well as recoupment and the application of the setting off of a recoupment. We are required to calculate the allowance on this building if the portion of the cost of that building, the new building, that qualifies for a deduction in terms of section 11G being leasehold improvements is 750,000. Something that we shouldn't have to tell you, but the taxpayer will elect any option available to him to minimize his tax liability. This is an assumption with any taxpayer, so even if we don't put that in, we will always, as a taxpayer, a logical taxpayer would want to limit their tax liability, and therefore they would choose any option that would either delay or remove that current tax. So now we have the cost of the building that cost the lessee 1.6 million. So that's the leasehold improvement. From that, remember, we need to deduct any portion of that we will get a section 11G, a leasehold improvement deduction for. So we were told in the required that that was going to be 750,000. Therefore, in terms of section 13, what is the cost of this replacement building? Well, 850,000. The recoupment that came from the prior building, we can elect to set it off against this new building. Therefore, we will deduct the 500,000, and that would give us a cost of 350,000, and our annual allowances in terms of section 13 going forward on the new building will be 5% on the 350,000. Same example in terms of information, but now we need to assume that the lessor is a municipality and that the erected building is an office building, not a manufacturing building. Remember, if the lessor is a municipality, We cannot claim Section 11G in leasehold improvements because the lessor would never have included it in their taxable income because they are tax exempt. Therefore, we as the lessee are deemed to be the owner of those leasehold improvements in terms of Section 12N. So what will happen? Well, we have the cost of the erection being the 1.6 million. What portion of that cost is subject to the Section 13 Quin? Remember, because this is an office building allowance. If erected on property owned by a tax-exempt entity, we are going to apply Section 12N, which then deems us to be the owner, and therefore we will be entitled to a Section 13 Quin allowance. What is the cost that we will apply? Well, the cost of the building was 1.6 million. We did not get any deduction in terms of Section 11G because it is disallowed because the lessor is a tax-exempt entity. Therefore, we will look at the 1.6 million. We cannot apply the recoupment against this 1.6 million because that only applies to a Section 13 asset. This is a Section 13 Quin allowance, and therefore we will not be able to set off that 500,000 recoupment. The cost on which the annual allowance will be based will be that 1.6 million that we actually spent. The annual allowance will be 5% in terms of Section 13 Quin. Remember, we will include that full 500,000 allowance in our taxable income as a recoupment because we are not allowed to set it off against the cost. Just remember, if an office building is erected on leased land and Section 12N is not applicable, then no Section 13 Quin is allowed. Okay, remember, we only get Section 13 Quin where Section 12N applies. So in the case where we exceed the contract value, we cannot apply Section 13 Quin if the lessor is not a tax-exempt entity. Section 8.4e is the deferment of the recoupment. We can only apply Section 8.4e if the taxpayer has elected paragraph 65 or 66 from the 8th schedule. What is paragraph 65 and 66? Well, 65 is where there is an involuntary disposal of an asset other than a financial instrument. So it could be expropriation, loss, or destruction. And we have acquired a replacement asset. We may then defer the capital gain. So that's what paragraph 65 says. If we elect to defer the capital gain in terms of paragraph 65, we will also defer the recoupment in terms of Section 8.4e. If we have an involuntary disposal, we can, on any capital asset, do the deferment of the recoupment. In the case of a paragraph 66 voluntary disposal of an asset that was subject to a deduction in terms of either 11E, 12B, 12C, and 12E, and the proceeds are reinvested in a replacement asset, we may then defer the capital gain and therefore also the recoupment in terms of Section 8.4e. What is important to note is that under paragraph 65, we could defer even with a Section 13 or 13 Quin or 13 Sex. However, with a paragraph 66 where it's a voluntary disposal, you do not see those sections listed, therefore it would not apply to any of those immovable property allowances. What are the requirements in order for Section 8.4e to apply? Well, the contract for a replacement asset has to be concluded within 12 months, and the new asset needs to be brought into use within 3 years of that initial disposal. The proceeds must exceed the base cost, so there has to be a capital gain on the depreciable asset. How do we defer it? Well, we need to look for the capital gain as well as the recoupment, we will take the capital allowances in the year on the replacement asset divided by the total capital allowances multiplied by the capital gain, or the recoupment in order to work it out on the recoupment. So for the recoupment, we're going to use the same percentage that the allowances were claimed on the replacement asset. Pause the screencast to have a look at this example. We need to calculate the allowance and recoupments with regards to the above if the company elected the application of paragraph 65 of the 8th schedule. It asks us to ignore capital gains tax and VAT. So we are telling you that they're electing paragraph 65, which is where we have an involuntary disposal. Therefore, we need to go and have a look at whether or not we can defer this recoupment. In year 5, this company had a manufacturing plant that was destroyed. The manufacturing plant was already written off in year 4, and the company was insured and received 1.8 million in the same year of assessment as the year that it was destroyed, year 5. The amount was immediately used to fund the purchase of a new or similar plant that cost 2 million. The recoupment of allowances under section 8.4a on the destroyed plant amounted to 700,000. So we're giving you the recoupment value. You do not need to go and calculate it. What we do need to work out in this question is whether or not we qualify for that paragraph 65 and therefore what impact that's going to have on the recoupment. So we replace that asset within a year of the asset being destroyed, and we brought it into use, and we can assume that it was brought into use immediately as well. What is the implication? Well, when we have a look at year 5 being the year in which that asset was destroyed, we will be allowed to claim a section 12C allowance on the new plant. Okay, so don't forget about the new plant and doing the normal easy section 12C allowance. With regards to the recoupment which we were given of 700,000, we will be able to, or we should include the same percentage as we are claiming the allowance on the new asset. So in other words, 40%. The calculation of the 800 over the 2 million is literally just saying the 800,000 that we got as a deduction for the new plant divided by the total value of the new plant, which is the same as saying 40%. So in year 5, instead of including the full 700,000 recoupment, which we would have done under section 8.4a, because we've elected paragraph 65, we will defer the recoupment over the allowances that we claim on the new replacement machine. So we get a deduction of 800,000 for the new machine, and we will include a recoupment of only 280,000. In the following years, from year 6 to year 8, we will again get those allowances in terms of section 12C on the new plant, and we will get the recoupment in the same percentages, which will then be the 20-20-20. So as you can see, the impact of this is that rather than paying tax now on the 700,000, we are delaying the tax effect by bringing in only the portion that relates to the allowances on the new machine. If we look at a recoupment in terms of a hired asset which we at a later stage end up purchasing or owning or just continuing to use, there is a recoupment in terms of section 8.5 that we need to calculate. We need to go and have a look at the value that we actually got as a deduction while we were hiring this asset, so either under finance or an operating lease. In the case where we return the asset to the lessor, there'll be no tax implications. We will not consider Section 8.5. Or if we acquire it from the taxpayer and the rentals are taken into consideration towards the settlement of the purchase price of the property, we then need to consider Section 8.5. Or where we acquired it as the taxpayer for no or inadequate consideration, we then need to consider the recoupment in terms of Section 8.5b. Or if we just continue to use the asset at no or nominal rental, or if we continue to use it at rental payments that are greater than the nominal rental, then there will be no deemed recoupment. So to summarize, if we return the asset to the lessor after the lease, no tax implications. If we continue to use it at the end of the lease, but our rental payments are greater than the nominal rental amount, again, no tax implications, no recoupment. If, however, we acquire it and the amount that we paid in terms of rentals is considered consideration towards the settlement of the purchase price, we need to consider where we have a Section 8.5 recoupment. If we acquire the asset for no or inadequate consideration, again we need to look at a recoupment. And if we continue to use it for a nominal rental amount, again we will need to consider the recoupment. There is a decision tree that you can spend some time working through to decide whether or not we need to apply Section 8.5 recoupment. If we have a look at an example, we have Croc Earth Moving Equipment, a company that manufactures earth moving equipment, classified as a process of manufacture. The equipment is used locally and internationally by mining and construction companies. You need to follow the transactions relating to the 2019 year of assessment, where we have a December year end. All amounts exclude VAT. Since the 1st of April 2016, Croc Earth Moving Equipment leased a delivery truck with a cost price of $780,000 from Rentals Limited, a non-connected company, for 25,000 Rand per month in terms of a 3-year lease agreement. It's a lease agreement, it's an operating lease, therefore for those 3 years we would get a deduction of 25,000 Rand per month. The agreement states that at the end of the rental period, Croc can continue to use it for a rental of 3,000 per month. The Commissioner will allow Croc Earth Moving Equipment to write off the delivery truck over 2 years, being the remaining useful life from 1 April 2019. So that's when the 3-year rental contract ends. We are required to calculate the income tax implications of the above transaction for the 2019 year of assessment. Well, in 2019, we will be able to get a deduction for the rental payments up until the 31st of March 2019, being those 3 rental payments. The rental payments that we incur from 1 April would be allowed under Section 11A, and that would be for the remaining 9 months. However, we need to consider, because we are now continuing to use the asset after the end of the rental contract, we need to consider whether or not we need to calculate a Section 8.5 recoupment. In order to do that, we need to take the cost of that asset. Originally, it had a cost value to Rentals Limited of 780,000. We will reduce that value by 20% on the reducing balance method in order to get what we calculate as a deemed fair market value. A quicker way to get to that same answer would be the 780,000, 80%, 80% times 80%. That will still give you the 399,360. Now that we have the deemed fair market value, we need to go and compare that to the allowances that we claimed and see whether there is a recoupment involved. However, we also need to check whether or not there is a nominal rental that is being paid as a result of the change in the amount after the lease period. That nominal rental amount is calculated by looking at what the annual rental would be under the new terms, being the 3,000 for 12 months, so 36,000. If those rental payments are less than 10% of that deemed fair market value that we calculated, of the 399,360, then the rental is deemed to be nominal, and therefore Kroc will be deemed to have acquired the delivery truck for no consideration for purposes of Section 8.5. The company must then include in its income the lesser of the deemed fair market value of 399,360 or the rentals that were previously deducted, whichever is the lesser. Well, we were able to claim for 36 months 25,000. 25,000 for 6 months is 900,000. Therefore, the lesser of the two is the deemed fair market value that we calculated in the 399,360. However, because we are deemed to have acquired this asset, we will be entitled to a Section 11E allowance on the asset, and therefore we will take it over the 2 years that was given to us. Remember, Section 11E is apportioned, and we only used it as our asset as the owner for 9 of the 12 months. Section 11O, the alienation, loss or destruction allowance. Remember, we said it must be elected by the taxpayer, and it cannot be elected if it was sold to a connected person. We will claim it where the cost of the asset exceeds the proceeds plus the tax allowances. So if the tax value is greater than the proceeds and the allowance on qualifying assets in regards to those sections has been allowed. As you can see, it only applies to movable assets, not immovable assets like land and buildings, because the expected life needs to be 10 years or less from date of acquisition in order to qualify to elect Section 11O. If the asset is acquired for no consideration, so it was maybe donated to us, we cannot have a Section 11O because we do not have a cost. Okay, so there must be a cost. If the full consideration for the disposal does not accrue in the year of assessment, so that could be in the case of unquantified amounts for level 2 only, we will disregard the Section 11O loss until we can fully quantify all of the amounts. If we still end up with a Section 11O loss, we will then be allowed to take it into account.